In an upcoming Trump 2.0 presidency, questions about the path forward for financial markets are many, up to and including the landscape of emerging markets. With tariff and trade policies that could put unprecedented pressure on longstanding U.S. alliances, as well as a dovish Fed, could this pose growth and inflationary risks for investors? Well, we're going to discuss that right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining us today. Please join me in welcoming my guest to the studio, Anisha Goodley, the head of the Emerging Markets and Global Fixed Income Portfolio Specialists team at TCW. Anisha, thanks so much for joining us in the studio today.
Thank you so much for having me.
Yeah, my pleasure. And look, we set up this a couple of weeks ago, yes, and the timing really could not be any better.
Nothing's happened.
Nothing's happened at all. The news, it's been so quiet out there, right? There hasn't been a U.S. election or anything like that, or a Fed that decided to cut rates. We're being, of course, a little bit sarcastic here, but that is really the question, right? We're now past the U.S. election. Donald Trump will become the president again, and we know that he has discussed on the campaign trail tariffs. China was the big, country that he said was the most, 60% tariffs across the board. Now, of course, policy is one thing when he gets into office versus what you talk about on campaign trail. But I wanted to ask you, just from the EM, emerging markets lens, how do you feel that the results of the election are potentially going to impact EM overall?
Yeah, no, absolutely. And this is a question we're getting a lot,
I'm sure.
Of course. And I think that, it's quite differentiated. And so one thing I would say, just to kick off, is that the markets priced in the Trump victory in a significant way in advance of the election, actually, right? And on top of U.S. growth exceptionalism. So you effectively, in October in particular, saw a big move up in Treasury rates. And you also saw the dollar rally. The dollar's almost effectively at highs. And so the post-election reaction has not been as severe as you would expect. But I think what to your point about tariffs, Trump has been very clear about various policies, right? So whether it's deregulation, which is pro-growth in the U.S., or tariffs or immigration policy, which is growth negative, what we think in emerging markets and what you're seeing a bit in the markets is that there's differentiation, right? There's winners and losers. And so a lot of what we're doing, and we've done in advance of the election, is really roll out various scenarios of, okay, who could benefit and maybe not necessarily, and who could benefit in a Trump trade war and who couldn't. And so when we think about countries like Brazil or Indonesia, they may be a bit more shielded from a Trump trade war, but as you pointed out, China and Mexico. Now, the other thing I'd point out is that this isn't his first presidency.
That's right.
As you mentioned. And so what we have seen is actually countries originally were not prepared. Right? They were not prepared for this, but now they're much more prepared, right? Europe has a plan, right? China has a plan. And so when we think about, what we don't know quite yet, and the markets will struggle to price in, is the magnitude and the sequencing of these policies, right? We've gone from effectively election uncertainty to policy uncertainty.
That's right. And we may not know about that for a few months.
Right.
Day one doesn't start until mid or end of January.
No, exactly. But what we do know is something like China, for example, that they're prepared for some sort of tariffs, and the extent it's not clear. But what we're also watching for is, if there are severe tariffs, will they come out with more stimulus as a result? So there are these important offsets, and I would just tie it back to your original question in terms of really needing to differentiate between the winners and losers.
That's right. Recently in China, as of last week or maybe a week and a half ago, they did have one of their meetings, and it was they did announce, China, that they were planning to cut taxes for home purchases from 3% to 1%. So that's sort of the beginning of another stimulus package, which, if ever we recall, earlier this year they had another one which didn't go maybe as well planned as they thought it would, given what the economic data has looked like for the country. So given that, and China's not obviously it's the biggest, but it's not the only country within EM. When you look at the overall landscape, and particularly you're covering the debt side, the fixed income side, because here at UBS, our CIO in Asia Pacific has a neutral on Chinese equities. So when you look at that, and then you see where you're coming from on the debt side, what are your thoughts on the landscape?
Yeah, no, I think absolutely. And so, and China matters. No matter what you're investing in, China matters. And you have to pay attention to what's going on there.
One of our biggest trade partners.
Exactly. And it has a significant impact on global growth. And so I think to your point about Chinese equities, one thing I'd love to mention in terms of the EM fixed income universe is that in our sovereign benchmark, we have about 70 countries. China's only around 4.5%. right? And so when you think about, the EM equity universe, it's very concentrated in China and it's very concentrated in Asia in particular. So you're quite correlated with what's going on there, right? In EM, of course, there's a correlation there, but what you have is a pretty diversified universe of Latin America, of Eastern Europe, Africa, the Middle East. So countries that may not necessarily be in the equity market. So when you're asking about, okay, what is the impact? We actually feel like there are some different drivers of growth depending on where you are invested, and that we have a much broader opportunity set to invest in. The other thing I'd mention is that the universe has changed. So if you think about actually 20 years ago when our EM sovereign index was started, it was 8 countries. Now we have 70.
It's expanded
right?
immensely,
it's
right?
expanded,
Of course.
and not only has it expanded, you've gone from pretty much a very, a high yield market to now the index is about 50% investment grade and 50% high yield. So what that means is that the credit quality has improved pretty significantly, and the opportunity set, again, has broadened out. So when we look at the overall universe, you really have this diversified mix of high quality investment grade down to frontier markets that you can't access in the equity markets. And so to us, we actually feel like, when we can talk through some of the themes that we're expressing, but it ends up being, again, China's not the most significant part, but it's an important part, and it certainly matters in terms of trade alliances.
Well, yes, and I do want to talk about the themes. I also, because you brought up the U.S. dollar, and we have seen the dollar strengthen significantly since the results of the election, the Trump victory. And of course, when we look at anything outside of the U.S. that's dollar denominated, it's going to take a bit of a hit, especially when you look for, in EM, the dollar strength increases import costs, and so that's usually a negative for EM overall. How are you seeing the strength of the dollar impacting right now?
Absolutely. And so look, the dollar's been strong for so long,
Yeah.
right? It's been just in this very, and there have been fits and starts with that, but really it's been quite strong for us on a sustained basis. And you can look at various models and say that it's overvalued, et cetera. But one thing I would say, when you think about the EM universe and the big shift that we actually, when we were talking about that improvement in credit quality, that's a buffer.
That's right.
Right? And the other major shift is that, back in the day, these countries were largely issuing in dollars and they had fixed exchange rates. Now, actually, most of their issuance, on average, is local. It's in their own local currency, so it provides a natural buffer because now you have local investors that are buying their debt. You've seen the development of the local investor base. So that's a very natural buffer against dollar strength. Now, if you think of EM, there's also in the fixed income space, you can give or take, let's say half of the index they're exporting commodities. They're generating revenues in dollars as well. So again, that's another buffer. So structurally, we actually think the asset class has been quite resilient because you've seen better macro policies. There's a current account surplus on average. And so that doesn't mean the dollar doesn't matter. It just means that when the starting point right now is much better than it has been in the past.
Right.
Now, in terms of in terms of the reaction, yes, the dollar's pretty much at the highs, if you give or take. And so again, it really ties back to that differentiation and the fact that it's hard for us to really price in a significantly stronger dollar. Right? It's hard
Versus
for the
where it is
markets
right
versus
now, you
where
mean.
it is right now. It's
Right.
hard to be put differently, it's hard to be overly bullish on the dollar, but that doesn't mean that there can't be short-term volatility. So when we look at our main portfolio, almost all of the exposure has been in dollar-denominated debt, which is what's outperformed over the last decade. We've really, again, not really seen local currency outperform significantly outside of a few years.
Right.
So
let's look. So back to when we were talking about the EM universe and those themes.
Yeah,
If
yes.
an investor is looking to us right now and saying, it sounds like there's maybe some opportunities there.
Yes.
What are those opportunity sets? What do they look like?
Absolutely. And I think, it's really that combination of fundamentals and valuations, right? And so I think we can very much acknowledge that the asset class was under pressure for several years, right? And so you had the COVID shock, you had 2022 with the food, the Russia-Ukraine war, you had the food inflation and inflation shocks. I mean, that's very legitimate. You did see a spike in sovereign defaults at that point. I think the big transition that we've seen is that we would argue that EM is now more early to mid-cycle, and it's been in more recovery. And so EM high-yield sovereigns, let's say last year were up 15%. This year they're up 13%. Since the election, they're up 1%.
Yeah.
Right?
We were talking about, in general, it's been a really exciting time
Yes.
for fixed income. And then you
Yes.
look at the sovereign side,
Yes.
and there's still a ton of activity there.
Exactly, and if we think about that activity, so there's been around 150 billion of outflows in emerging markets dedicated funds since the beginning of 2022. I mean, that's significant.
That is
and
significant.
that's meaningful. And I just gave you some percentages on some of the returns for last year, which is included in that. So what we've seen is actually global investors and multi-sector investors, fixed income investors that can invest more broadly, are investing in fixed income. We see new issues are multiple times oversubscribed, and we're seeing it in the returns. Now, what does that reflect again to us is this improvement in fundamentals, because you've actually started to see these EM economies, really, they've been restructuring their debt, they've been shoring up their balance sheets, fiscal consolidation, and then the valuations. I mean, if you think about, I think we can agree that probably credit spreads everywhere are tight.
They are
right?
very, we've been talking about that quite a lot.
I'm sure your colleagues have been talking about that at
100%.
length, and that's right. If you look at whatever region you're really looking at, they're on an absolute basis at the tighter end of the range.
That's right.
But then, if you think about what we talk about in terms of fundamentals and credit quality, EM and valuations EM is still cheap relative to developed markets.
Right.
So I'm happy to give you some numbers to that, but that's the trade that we're seeing, is that you're seeing global investors, crossover investors invest in EM, pick up spread, move up in quality, and we talked about this stat earlier. Triple C's in our market this year are up 40%.
Yeah.
A reflection of that.
It's incredible. And the one thing I want to ask you before we go is, because this comes up a lot in lots of conversations, is the impact of the U.S. Federal Reserve. Now, of course, there's Federal Reserve banks all over the world, global central banks that impact everything. But when we're looking at a dovish Fed here in the U.S., meaning we're going to continue to cut rates, our base case is 125 more between December and next year. But if inflation does kind of go the other direction, depending on tariffs and other items, could a no landing scenario impact EM as it hits the U.S. markets?
Yeah, but I mean, look, it's all about the sequencing, right? If you think about the Fed continuing to cut rates, it's really about the pace of those rate cuts. Right. So are they cutting rates incredibly fast because the data is weaker than originally expected or priced in, or is it more measured in nature, right? Is it where do we land on that? And that's a little bit still unknown, but our team would agree with you as well that we anticipate significant, further rate cuts from here. And so in terms of EM, that improves financing costs. Right? That's why we've seen high yield also benefit, right? Because of the fact that financing costs can be lower. And so that certainly helps. It helps investment grade markets that are more rate sensitive too. And then it really does help those lower income economies that may have more dollar debt in nature too. I think, circling back then to those themes, I think what you're also pointing to is that there's the macro and then there's the domestic, right? And so you have, what we're also excited about, if we get, again, we're in this period of policy uncertainty, and we're going to need more information, and the markets struggle to sometimes price that in. But if we think medium to long term for emerging markets, and I talked about how it's a much more diversified universe, and so we can access Africa, we can access the Middle East, we can access parts of Latin America that may not have equity markets, and so what we're seeing actually is that you have, EM still has very critical minerals, metals and mining, basically, that the world needs.
That's right.
And if you think about the last few years, with geopolitical risk, the U.S. and China have both been establishing more alliances with emerging markets. Emerging markets have basically become a strategic force in that, and it's 25% of global fixed income. And so, it's certainly a standalone asset class.
It's pretty significant.
It's certainly significant, and you've seen that, in this multipolar world, both the U.S. and China want more alliances with emerging markets countries. And so that benefits. If you think about the climate transition or the growth of AI and the need, again, for metals, EM can benefit. If you think about the demographic advantages that emerging markets have, or the technological leapfrogging that's frankly going on in emerging markets. And so that also all helps drive growth in our view when we think longer term. So we're actually quite constructive. We're constructive on hard currencies, so dollar-denominated debt. We don't really have significant exposure in our main portfolio to local currency for many of the reasons that we mentioned.
That's right.
And we're overweight high yield. But it's quite balanced in terms of focusing on some of those idiosyncratic stories.
Anisha, thank you very much. Again, Anisha Goodley from TCW. And thank you all for joining us. For more information on anything we discussed today, plus lots of content out of our Chief Investment Office, visit our website at ubs.com/views. Plus, you can follow UBS on social media. We're on all the major channels, including Instagram. Follow us at UBS Trending. And as always, if you have any questions about what we spoke about today, make sure you're chatting with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon.